This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, January 6th at 7:40 Mountain Time. This complimentary version of our uh, weekly summary of our weekly note, which was titled Beware January Reversals. We began this week's discussion with a somewhat esoteric concept or idea, which is the Treasury term premium, which is the uh, move in the Treasury market that cannot be explained by Fed policy expectations, um, or the premium that you pay or you receive, excuse me, for extending duration. And we're focusing on the 10-year part of the curve. And it was all prompted by Torsten Slok's note on New Year's Eve that the term premium has moved up 75 basis points, 0.75%, since the Fed began easing back in January. Now, all of that is not, and by the way, this is all available in the preview part of the note, the complimentary part of the note. So we urge you to go look at the specific details of it and look at the chart that we have up in this audio as well, and just think about it a little bit. But as you can see in the early 90s and early O's, the term premium widened significantly when the Fed was easing sharply during those periods. But the Fed didn't hold any longer term securities at that point as they do today. We wrote in our thematic year-end note about the effect of the overhang of the Treasury's holdings and the active Treasury or activist Treasury issuance, focusing primarily on or largely more than they should otherwise probably on financing our 7% deficits with Treasury bills. So all those things have held down term premium. And our argument here is term premium should go and could go significantly higher through the course of this year and over time. But ultimately, to stabilize it, we need to get the debt and deficit under control. Now, no one wants higher rates, of course, but if you look at history around all of this, letting the market set rates has historically been much better for capital investment, productivity, and the overall welfare of the country. The 60s and 90s, for example, we did not have financial repression. We did not have Fed suppressing longer term rates. We had very strong CapEx and we had very strong productivity. Whereas in the 50s and 2010s, we had financial repression. Rates were held down. The term premium during the 10s in particular, when the Fed entered into the QE era, led to very weak capital investment and very slow productivity growth, at least until the very end of the cycle. So that's the sort of theoretical part of the note. Now, the title was Beware January Reversals, and that pertains to the next section of the note where we discuss the post-election bounce in business confidence, which is boosted orders, and the outlook for orders is boosting CapEx plans, but it's not having much impact on the employment market as of yet, which brings us to Friday's payroll report, which is absolutely crucial. It does, on balance, to us look like it could be a softer report, in which case we could very well get a fairly significant bounce in treasuries after auctioning threes, tens, and 30s this week and potentially putting even more pressure on the treasury market. We then went on to have a discussion about how the Chinese global deflationary impulse is, if anything, intensifying. They've made some progress on stabilizing house prices, but they're clearly in a liquidity trap where households are hoarding cash because of concerns about their biggest asset, which is the house prices. And that deflationary impulse, which is impacting global goods prices, is unlikely to change anytime soon. Chinese bond yields have been plunging. Stock prices have been plunging as well. So we then wrapped it up with a discussion about the markets and how we did have a stealth or pseudo correction through the course of January. That's created opportunities in energy, industrials, and materials. We probably wouldn't buy tech here. More likely, just tactically, we'd probably wait for earnings. But beware these reversals. The dollar has been strong. That could reverse on weak payrolls. Bond yields have been surging. They could reverse as well. And we could get back to this broadening out, though earnings season does loom quite large. Great app from Ironsides. Have a good week, everyone. Make your New Year's resolution becoming a full subscriber to Ironsides Macro. Thanks. Have a good week.